Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, July 22nd, 2016. Again, this week stocks pushed to all-time highs with another hollow black candle on the weekly chart. This is showing broad strengths within the market. We'll look some of the market breadth indicators that I look at. We'll compare IWM versus IJR, the two small caps ETF, and we'll compare QQQ versus the XLK, the technology ETFs. I think the RSP, the equal weight S&P 500 ETF, is really worth 1,000 words when we look at the graph. Bonds are attempted to stabilize. We'll compare MUB versus TFI, the two major municipal bond ETFs. Bull flag breakout possibly on the US dollar index chart. Then we'll look at the US dollar versus JPY and see if it really has reversed its downtrend. Finally, gold is feeling the pressure from the strong US dollar. Oil is also pressured, but most likely because of the oversupply. And we'll also look at natural gas, which is attempting to bottom. And I wanted to also add one more thing. We'll look at cocoa, which is also has an interesting chart. All right, let's look at our proxy for the market, which is S&P 500 ETF SPY. So this is a all-time closing high just on Friday here, and we're sort of had a big surge, and we're sort of consolidating in a sideways manner. So basically at this point I'm looking at the it's possible that we simply just continue higher. We get another breakout, continue higher. Another possibility is that we pull back. I don't know how deep of this pullback will happen, but obvious supports now are at this breakout level at around 211 at the 50-day moving average. Another support, very strong support here, I think, is in this area because there's just lots of things happening in that area. Like, for example, there's lots of touches to that area, and this false breakdown. This is clearly a bear trap, and now there's a 200-day moving average around that area. So around, here is very strong support. So I think if we do correct that area, that there's going to be a lot of buying that's going to happen in that area. Also, I showed this big volume spike during the Brexit, and I mentioned back then, you can check some of my previous videos, that this could be one of two things. This could be either initiation or a climax, and in this case it was clearly a climax, and then we reversed and rallied back up. So as far as the market breadth is concerned, I think it is confirming all-time highs. You can see that the advanced decline line is hitting all-time highs. These are all-time highs for advanced decline line. As far as the advanced decline volume line, I think these are not all-time highs, but they're also moving generally up as well. One thing here is this intermediate term breadth momentum oscillator. This oscillator is basically an oscillator of the advanced decline line of this line, and you can look it up if you're interested in how it is calculated. But one thing that I noticed, that it has not been in a negative territory for quite some time, and usually, ideally, I think there will be a foray into negative territory, and then followed by continuation higher. This has not really happened, so we could possibly, correct down, and then the oscillators will go into negative territory, and then we'll see if the support will be found. But as of right now, I think the market is clearly bullish, and I think that buying on any pullback would be a wiser decision than to look for top-end formations at this point of the game. This chart shows S&P 500 without the dividends, this underlying index, with a breakout above this consolidation around 2134. We now have 2 weeks with the closes above this all-time high. So really, the more it stays up here, the more valid this breakout becomes. As of right now, I think this is a valid breakout. If we do get a pullback, a throwback level to the breakout level a throwback to the breakout level would make sense. But I think it might actually be a buying opportunity, and I think at that point we may see more buying commands. As far as the volume patterns, I don't see anything terribly unusual. We had this is a Brexit spike, and this was elevated volume, so that does make sense. Right now, of course, the volume is dropping because, there is really, not much up here. I mean, we're taking out the stops that were hidden above these levels here, so it does make sense that the rally continues because the stops get taken out. The short stops, I meant. New York Stock Exchange Composite, this is a broader indicator, or rather this is a broader composite than the S&P 500. These are not all-time highs. The all-time highs were back here, but nevertheless, I think we are getting a breakout. You can see there's a breakout above these highs, above these peaks here, and we attempted 3 times, or rather 4 times in the past, 1, 2, 3, 4 times in the past to break above them, and we failed. Now we did break above this peak, so that's a positive sign. There's broad participation in the markets. Pointed out this indicator, which is new highs less new lows divided by total active symbols in the past, and we can see we're making a lot more highs than of the lows. Back here, we were making a lot of new lows. Now we're making lots of new highs. As far as the advanced decline line and advanced decline volume line, I think these are also confirming the breakouts. Breakout above this level here. So far, I'm not seeing anything that will indicate that this is a failed breakout. Very broad participation. You can see bullish percent index is clearly in the bullish territory. If we even draw a 50% trigger, then this is above 50%, but we can say that the trigger is 60%, and we're clearly above there. The same goes for percentage of stocks above a 200-day moving average. We're in a bullish territory, and I don't see anything to negate that at this moment. All right, so that's it. Again, this is the same breadth momentum oscillator, ITBM, which is this is an oscillator of the advanced decline line. And again, the only thing that I would see is possibly a foray into the negative territory, something like along these lines, and then you can see that basically it oscillates between positive negative territory, but it has not done so for quite some time, since basically February of this year. So we may be a bit overextended on the upside, especially after this latest move of the Brexit lows. So I thought I'd look at some of the ETFs that are main ETFs really. So this is IWM, Russell 2000, and this is a weekly chart on a weekly time frame. You can see that all-time highs for IWM really were almost a year ago, really. So far it has not hit all-time highs, while the S&P 500 is hitting all-time highs. So I was looking around and came to another major ETF, which is IJR, which is also a small cap ETF, but it is slightly differently composed. So you can see that it is hitting all-time highs, and this is the same weekly chart as the IWM. So I was wondering why that is happening, and what is the general performance of these two ETFs over the longer term time frame. So what I did is I put them together on the same graph, and very interesting that even though they are both small cap ETFs, the IWM, Russell 2000, consistently underperforms IJR. As a matter of fact, currently the underperformance is very significant. It's about 10% underperformance. So whereas IWM is still way down below the all-time highs, the IJR is already hitting all-time highs. So that's very interesting on the performance. And I think that the reason is because of the compositions of the two. So I went to iShares website, and this is IWM Russell 2000. You can see there's a lot of financials in this group. Versus IGR, which has a little bit less financials. And I mean, they have very similar composition, but they're slightly different. So you can, kind of look and compare. Like, for example, here we have more technology, while here we have more industrials. And actually, industrials have been very strong as of late. They are also hitting all-time highs. So this IGR is currently better positioned because it has less financials, more industrials, etc. There are minor differences, but it's just something to keep in mind that when you select the ETF to trade, the most popular ETF may not necessarily be the best one to hold out there. So IGR in this particular case clearly outperforms IWM. Here's another ETF that's kind of interesting, is that QQQ versus XLK. And QQQ, even without the dividends, is still approaching all-time highs, while XLK without the dividends has been hitting all-time highs, and in fact it hit all-time highs recently here as well in April of this year, and now also again in July of this year. So XLK clearly is outperforming QQQ. You can see that QQQ still has not hit all-time high. And I was wondering why that is happening, so I went to QQQ Invesco PowerShares website, and I noticed that versus XLK, you can see that XLK has more of the telecom stocks, for example, AT&T and Verizon, versus QQQ, which doesn't have those stocks in the top 10 holdings. And AT&T and Verizon has been hitting all-time highs. They're kind of almost like utilities, proxies also. So, XLK in this particular case is outperforming QQQ, and that's again something to keep in mind when you're selecting ETFs to trade. Then in this particular case, XLK outperform, but over the long run, most likely they'll be very similar to one another. Finally, I wanted to show RSP, which is a this is as broad as it gets, most likely, as far as the tradable vehicle. This is RSP. This is a S&P 500 equal weight ETF. So each of the stocks within the S&P 500 is weighted equally, and it is hitting all-time highs. And this is really very telling, and this shows extremely broad participation within the markets. This whole dip, and these are actually 2-year multi-year lows, have been completely reversed, and we're now at all-time highs. So I think the market has basically reversed from a bearish posture into a bullish posture, and most likely will continue higher. Alright, moving on to the bond universe. This is TLT, 20+ year Treasuries bond fund. So a very bullish chart, I think, but as I kept saying, this move is, especially this move from here, from this low, it was really like very steep and vertical advance, and I kept saying that this was unsustainable and I would never buy up here. So we're now coming down to more sane levels. For my taste, I think this is still a little bit overextended. I mean, I'm looking for it to get a deeper pullback, and then I'll be looking to re-enter on the long side, and of course my subscribers as well. So this is still a bullish chart. So why is it's weird, because both stocks and bonds are hitting all-time highs, and I think this is due to interference from the central banks, because the central banks are buying up bonds within the bond universe, and thus they are expanding their monetary supply. This is an indirect money printing. Later on, we'll talk about Bank of Japan, which I think is getting ready to outright print money without the pretense of buying up assets. Nevertheless, bonds are bullish at this point of the game. This is a weekly time frame. I pointed out the depth of this pattern, which was 6.1%. We came up as around 6.2%, and now we're correcting. So I pointed out that this is a kind of like a limit of this particular pattern, and then we came down to correct. There's a deeper pattern. This is just enormous cup with handle. So this is a 20% mark. We're basically 6% there, so another 12% to the upside. Now, it's difficult at this point. The central banks are interfering so much within the markets that it is difficult to say that with certainty that if we get a move in bonds of that magnitude, the stock market will unravel. It is at this point difficult to say that because before we had pretty clear and inverse correlation between the stocks and bonds. Nowadays, who knows? Maybe they will just buy up all the bonds there is in the universe of the bonds, and then they will continue going higher. So in Europe, in Japan, in many parts of the Nordic countries, we have negative interest rates. In other words, you're paying to the government for the privilege of giving them money. This is a bizarre world, but it is nevertheless what it is. So for our investment purposes, it's good to have a diversified portfolio. Whether it is a 401k like a retirement portfolio or whether it is a trading portfolio. So for our purposes, I'm looking at basically looking to get long again on the TLT and continue higher. In most likely will continue higher. As far as AGG is concerned, this is more diversified bond fund. Very similar picture to TLT. Again, very steep, almost semi-vertical advance here, and now we're correcting back down. Again, very bullish chart, so I think that pretty much any significant pullback should be viewed as a buying opportunity for bonds. And this is a longer term time frame for bonds, and this is a pattern I kept pointing out. This is a depth of this big, maybe like the triangle consolidation, and then a breakout above the triangle and continuation higher. So depth of this pattern was 3.4%. We got 3.4% move and then some, but now we're correcting. So I wonder where this correction will take, how deep of a correction we'll get. I mean, maybe the United States Federal Reserve will decide to raise interest rates, so certainly this will weigh on the bond funds, but to what extent it's difficult to say, because I think the market is really expecting for further interference from the central banks. And then I wanted to show a couple of municipal bond funds, because municipal bonds are actually not part of the general aggregate bond funds, like AGG. So if you are a bond investor, it would make sense to own TLT, possibly AGG, and possibly one of the municipal bond fund. But I wanted to show this. Well, I think it's a kind of strange pattern. Is this really big white candlestick, and then we basically collapsed afterwards. So when I get this kind of patterns, this is just really throwing me off. I kind of tend to stay away from those patterns. So I was looking for other funds to own with similar characteristics, and I came upon TFI, which is also an ETF, very similar municipal bond ETF, very similar yield, 2.17%. This one is slightly higher, but not by much. So this fund also is at all-time highs, here, and now we're correcting back down. Here, a very interesting pattern, enormous volume here on Friday. This is indicative of potential bottoming pattern. Large volume spikes like this most likely indicate that we're coming to some sort of a bottom. I don't know exactly how it will happen, but I think this is indicative of that. On a longer term time frame, I want to compare the two, MUB and TFI. MUB, actually TFI slightly outperforms MUB in any case, so it kind of makes sense to own TFI in the first place as well. So we have, clearly a better fund, and also doesn't have this weird spike here for TFI. So I went to, and I wanted to see what was the difference between the two funds, and you can go to Morningstar, for example, and you can just type in the fund's name. The difference is basically in the quality of the quality mix, and this is MUB, and this has a moderate duration, but high, also high quality, versus TFI, which has longer duration but higher quality as well. So you can see a very effective duration 7.6 years, while here we have 4.71 years. So very similar funds, but I think TFI offers a slightly better return, possibly at a lower risk. All right, let's move on to the currency and Forex universes. So this is US dollar index, also traded as DXY. If you're in Europe and lucky enough, or rather out of the United States and lucky enough to be able to trade CFDs, unfortunately it is not possible to do it in the United States. But in any case, this is US dollar. I pointed out this potential bull flag, so like this pattern right here. And I think we're getting a bull flag breakout here this week, which will call for a move, well, I'm guessing to around 98, to possibly even higher to 99. I think we're going to challenge these highs here that I'll show in the next around 100 level. And this will happen, of course. This DXY is composed of mainly euro, but to a lesser extent of yen and the pound. The pound is clearly in a downtrend and hitting 30-year plus lows, but I will discuss yen in a little while. The euro is sort of in a sideways consolidation, but maybe we're already getting a breakdown. You can see that we're closing below these levels here. So maybe next week I'll cover euro in more detail. For the past few weeks I've been covering yen in more detail, really. This is a weekly chart of the same US dollar index. I kept pointing out this cup and handle pattern. You can look at some of my previous videos. Looks like we're breaking out above this downtrend, and we could continue higher. And again, if this was what I said, if we had that flag breakout, then most likely we're going to challenge this 100-point level here. Same charts here, but this is a weekly time frame versus the previous chart. So here's some interesting charts here. This is US dollar versus Japanese yen. If you trade the Forex markets, then you know that US dollar is on top, JPY is on the bottom, and in this case, JPY was winning versus the dollar. So we can see that it was winning clearly, and Japanese yen was strongly moving higher. In other words, US dollar was moving lower. But here we have, I think we have a bottoming pattern. We had a big spike that indicate buying interest, another attempt lower. So far we have not been able to break below this low of 99, and now we came up above the 50-day moving average and trying to stabilize there. On the weekly time frame, this is the same thing, US dollar versus Japanese yen. I pointed out this level here maybe 2-3 weeks ago, and so far we have, we attempted to close below it, but I think we've so far have been, we've been holding support here, and you can see there's 3 weeks we were kind of trading around that area here, and then rebounded. Also, I wanted to show on the US dollar versus the Japanese yen. This is you can go to trading view, and because this chart does not have volume, but here I get this is volume, but this is not a true volume because there's no true volume in Forex. This is a number of transactions basically that have been recorded. So I think that this is a bottoming patterns here, and you can see there was big spikes here near the bottoms. For example, this one was clearly right at the bottom of this pattern, and then we went higher, and then another spike right there, this big red candlestick. So looks like we're attempting to bottom here, and most likely we're going to continue higher. In other words, US dollar will win and Japanese yen will lose. And so I did a quick search for Kuroda. I got this first thing that popped up is says Bank of Japan to add stimulus. So in other words, if Bank of Japan is going to add stimulus, um, expand monetary stimulus. So that what that means is that the Japanese yen will depreciate versus other currencies. In other words, US dollar versus Japanese yen. This chart will most likely continue higher. In other words, most likely we are witnessing a reversal in the Japanese yen, US dollar versus the Japanese yen trade. Of course, some of them are more sensitive commodities that show a strong inverse correlation to the US dollar is gold and gold miners by extension. So as of late, correlation has been somewhat positive with the dollar and the gold itself, but I think we're gold is finally feeling the pressure from the strengthening US dollar, and most likely gold will at least come under some form of pressure if the dollar will continue higher. Now, this is a chart of gold, continuous contract on daily time frame. I thought that this spike was it, but we actually came a little higher. The reason why I thought that this spike was it because of this enormous volume. Clearly that did not happen. We came up slightly higher, and then we sort of started coming down. We will see where this is going. I think, for the record, of course, the gold is bullish, I think. So I think we'll look for, bullish setups, and we'll look to buy gold in the near future. But I think that right now, with the strengthening dollar, I think gold may continue lower, and there is support for gold here, of course, at 1252, and very strong support at 1201, 1200. There is a breakout level here, another touch of that level, another touch of that level, and now the 200-day moving average coming in around there as well. So lots of support in the $1,200 area. This is a weekly time frame. This is an interesting chart because you can see we had a breakout above the highest from 2015. So that is also going to act now, well, possibly act now as support. I think the bigger support here, of course, is at 1200, just like I said, but it's possible that gold will stabilize around $1,300 as well. I think it really strongly depends on what the dollar is going to do. Here's a longer term time frame. This is one of my proprietary market breadth indicators. This is a gold breadth index. I pointed this one out I believe this was in March, that gold has now entered a new bull market. You can see that before there were multiple attempts at the breakouts for gold, but they all failed, and only this final one was sort of speak true, I think. And the same, gold breadth index did not call any of those breakouts. It was still bearish at that in that point, and then it would have shown that we need to short gold. And in fact, we were shorting gold up until recently, and this was a final reversal for gold. So now I'm looking at bullish opportunities and bullish setups. As far as the derivative of gold, which is GDX, gold miners, these are 52-week highs. This is a very tight consolidation that has been resolved to the downside with the gap. So uh, we may expect more downside. This is an enormous move from $12 to $30. This is a very, very strong move. So um, absolutely some sort of a corrective pattern is in order. Also down here, I pointed this one out a few weeks ago. This is a bullish percent index, and here it was at 100%. And this was almost a surefire way to say that we're overextended to the upside. Looks like we're finally unraveling, at least in the short term, and then we can come down and maybe retest 24.80, possibly even lower to $22. Maybe even lower to the 50-day moving average, and maybe it's around this area at $19 or so. So it will really depend on gold. If gold completely just falls out of bed, let's say the dollar breaks out to multi-year highs, then we could see pressure in the gold complex. And finally, this is a longer term time frame for gold miners rather, and the same thing as the for gold. There were multiple attempts at breakouts, but they all failed. Only the latest one in 2016 was a success, which was called by my gold breadth index. Moving on to the commodities universe, this is West Texas Intermediate, daily time frame, continuous contract. So looks like we are under pressure. The support break, I think, is valid. So looks like we had a support break, a throwback, and then more selling, basically. And now we are below this level from July, early mid-July. Now we are at 44.19. This was at 44.42. So looks like we are. I think we're going to retest the 200-day moving average, and this is a same kind of level around 42.49. So I think we are headed more to the downside. This will really depend on the supply of oil, of course, and I think there's just lots of oil out there. And again, United States producers are cutting production, and if oil stays around $40, they might ramp up production again, and maybe we'll see oil get down to $35 or maybe even lower. So these are multi-year lows. In any case, I think this is a bearish security. It's more, even better illustrated if you look at the weekly, same chart, but weekly time frame. If you look at my previous videos, I mentioned that this is a most likely rejection candle. Looks like so far it's been proven true. We'll see how deep of a correction we get. Clearly, $40 is a good, maybe, decent support here around $40, maybe like $38. Next support level will be around 35 here. This is USO showing a possible, or most likely a rising wedge with a breakdown. And this is a bearish security, so how deep of a breakdown is difficult to say, and we may actually continue to multi-year highs again, multi-year lows again. This is natural gas on a daily time frame. So I use they have a nice tool here on the MasterCharts.com, which is called automatic support resistance. This sometimes really works well. So this is a breakout around $2.50. If you watch some of my videos, I pointed out this level repeatedly. This is a breakout above the major resistance. So now it makes perfect sense for this resistance to be acting as support. It's one of the tenets of technical analysis is, we have a support now sometimes acts as resistance, and this quite often happens. So maybe we're already getting a bounce off this area here, but I'm not yet 100% convinced that this is a true move. It's possible that we're going to continue higher to 52-week highs, but for my taste, I like to see a deeper correction before I jump in. So I'm looking for a little bit of a deeper correction before I reopen the long, or rather before I open the long in natural gas. A weekly time frame, I think it's always a good idea to zoom out to at the very least the next senior level. Like for example, if you're doing daily time frame, then zoom out to weekly. If you're doing let's say hourly, zoom out to daily. Here we have a very strong breakout from multi-year lows to a 52-week high, and now a certain rest and consolidation period is in order, and resistance was at $2.50, so now it potentially could act as support. We'll see where it actually lands, and if it rallies over the support. And of course, the tradable vehicle for natural gas is a UNG, very nice, high enough volume. You can also trade it as a CFD, and you can do options. Let's say trade on NADEX. You can do options there, but you can just trade it from the regular UNG. This one is, has a lot of gaps, so you got to be careful and account for those gaps when you calculate your position. By the way, if you do sign up, you get a nice tool, an Excel spreadsheet where you can calculate your position sizes very easily. Positions and targets. Anyway, so looking for a deep enough correction, and then I want to get long eventually. And finally, wanted to show one more security. I think I mentioned this one in the past. This is Coco. The daily time frame. You can trade this by using ETF called NIB, NIB. In America, you can trade it. NIB, unfortunately, has a very relatively low volume. This most likely is a bullish chart. If you can, it's really difficult sometimes to catch both up and down moves. So I kind of just go, if this is a bullish chart, I'm only looking at bullish opportunities. If this is a bearish chart, I'll be looking at bearish opportunities. I think this is a bullish chart, and I think we're kind of coming around to the support area. So it would make sense for a bounce to materialize here. And this is a weekly time frame of this same chart. Yeah, it's a little bit messy, but these are multi-year highs here, so maybe we're in a corrective pattern, and maybe we'll resume its uptrend in Coco. Also, volume is sort of indicative of a approaching of a bottom here. Anyways, if you like what you're hearing, check out MasterChartsTrading.com, and stay tuned on how to find us on the internet. Thanks a lot. Have a nice trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling, and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, you know, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. You know, send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.